So this is probably one of the most talked about and pressing topics in business and markets this year, trade tensions. What do you think's missing?
Yeah, the whole situation with China, the U.S. is very critical, particularly for China. I believe the situation is getting worse. Trump is not going to give in and is going to continue to hit at China in terms of the incredible trade imbalance. As you know, the trade imbalance is the biggest of any other country that the U.S. has. And I believe that it will be a real problem with China going forward. The good news is that some emerging market countries will benefit from this. Just to give an example, soybeans. The U.S. is a big exporter of soybeans to China, but Argentina could benefit. Unfortunately, Argentina is now suffering from a drought, and they had a downturn in their soybean production. But generally speaking, you're going to see the winners and losers coming out, particularly in the emerging markets arena.
Mark, have you ever known any time like this at the moment? And we are in uncharted territory, I suppose. And how do you look at it then from a fund management perspective?
You're absolutely right. We are in uncharted waters. You know, the previous American administrations pretty much endorsed world trade, freedom of trade, the WTO, and all of these other agreements, multilateral agreements. Trump is going in the opposite direction. He wants bilateral agreements. He is really upsetting the apple cart, so to speak. And therefore, the uncertainty will grow, not only in the general larger markets like the U.S. and Europe, but in emerging markets as well. So we're going to have to be focusing very much on individual countries, individual companies, to see where the winners and losers are going to be. But it's going to be a very interesting time in the next year or 2 years.
And Mark, at this point in time, do we know enough to figure out who the winners might be, in your view?
In our view, in terms of the emerging markets, some of the most interesting now, because of their tremendous decline in the currencies and in the markets, would be Brazil, would be one example. Turkey would be another example. And then, although India has not come down that much, there are tremendous opportunities in India because they're going to pick up some of the slack that is coming from the trade embargo on Chinese goods. So I think you have to look at those countries that will benefit from this trade war. South Korea would be another example.
Mark, there seems to be this creeping economic nationalism out there, right? You know, obviously Donald Trump. Turkey's another example of it as well, with Recep Erdogan winning that election and strengthening his own hand there. So how do you look at that then? And are you concerned about that?
No, I'm not that concerned because I believe that there's still a situation in Turkey where you can get opposition. There is an opposition, and there's a chance to protest if people want to. The good news is that in Turkey, you didn't have a runoff. As you know, if one candidate has less than 50%, there has to be a runoff, and that didn't happen. And that reduced the amount of tension in the country. Erdogan got 52%, and now he can go ahead with his big programs. As you know, they're going to build a new canal. That's going to be a huge project. So there's going to be a lot of construction activity in that country, which could be interesting. Of course, the currency is in trouble, and the trade balance is not very good. But generally speaking, I think they'll pull through.
Yeah, Mark, I was actually going to ask you about that. The currency's been hammered, and foreign money's been pulled out of Turkey. There's the Fed, obviously, but there's also just concerns over how President Erdogan's, well, he's handling or approaching the management of the economy. How do you think he's done as far as that's concerned?
Well, if you look at the history for the last 5 years, 6 years, he's done very well because he has put a lot of attention to the countryside. You know, in the past, it was the elite in Istanbul who were really making the money, and the countryside was pretty much ignored. That's changed with Erdogan, and that has given quite a revival to the economy, which is why he's been able to stay in power. So I think that situation is probably going to continue going forward. And with the big projects that he has in mind, that will also boost the economy to some extent. However, you, of course, have this problem with debt, big foreign exchange debt, and he has to address that problem.
Mark, do stick around. Mark Mobius, their partner and co-founder of Mobius Capital Partners, actually spent 40 years investing in emerging markets. Now, if you're a Bloomberg subscriber, do join the conversation with Mark Mobius by sending us instant messages during our show, during our live shows anyway. Do check it out. TV Go, that's your destination.
Yeah, and still ahead this hour, we'll look at what we can expect. There's a rate decision taking place today in Malaysia. Any change there or any sort of change in tilt that you should be expecting? And also here, Tesla planning a new plant in Shanghai, but analysts really want to know how they plan to pay for it. That's next. This is Bloomberg.
That's with the barge pole.
Yep. Hi, Mark. This is Rish and David here. Just want to say hi again.
Hi.
Good stuff, Mark.
Hi,
We should be with you soon. I'm very well. When are you coming to Hong Kong next?
Probably next month, by the looks of it, a little bit before that. Now I'm back. I just came back from London, so now I can stay in Asia for a little while.
Excellent stuff. And you are going to be in Korea as well, because we might talk to you a little bit about Korea. But the first question I'm going to ask is effectively about Chinese investment opportunities.
Okay.
All right, approaching midnight over in New York, which I would imagine would still be a fairly hot and dry at this point in time. Of course, midnight session there. U.S. futures down. We were down as much as 1.2% earlier on S&P. Dow Jones, as you can see there, 0.7%. So it's still a fairly risk-off environment right now, given what's happened.
Yeah, but to the here and now, Chinese equities at the moment very much in the frame. We've got Mark Mobius with us still. Mark, you talked to us in May, I think it was, on May the 23rd to be precise. You said that you saw significant opportunities for you in the technology space in China. Have those opportunities come and gone, or are those opportunities become more glaring as a result of some of the falls that we've been witnessing?
They're still there. And I'm talking primarily of the small and medium-sized companies that do components and other parts for the technology arena. I think there are tremendous opportunities in China in that regard. And, of course, a lot of these companies don't have to necessarily depend on exports to the U.S. They're supplying the domestic market, supplying domestic producers. And, of course, China is exporting to other parts of the world as well. So I think that's where the opportunity is. Many of these companies are ignored, and many of them can't get listed in Shanghai. So they're going to be listing in Hong Kong and other places in the future. But now is, I think, the time to look at those companies.
Do you think we've bottomed across emerging markets, just generally speaking, as, I guess, a sentiment play, if you will?
I can't say we've bottomed. Emerging markets, as you know, are down about 20-something% in general. Some markets are down more than that. I expect probably another 10%. As you know, about a year ago, I said probably a 30% decline, a 30% correction. And I think we still will achieve that. But, of course, now's the time to begin looking and locating those companies in emerging markets that'll be interesting. So the opportunities are going to get better. The currencies look very cheap, as you know, and the markets are down in many cases substantially. So places like Brazil, Argentina, these are really bombed out markets.
They certainly are, and they're bombed out, which, of course, presents the opportunity of be fearful when others are greedy and vice versa here. Does that adage hold true for you still?
Definitely. That's been always the case. In the 30 years that I've been investing in emerging markets, that's always been the case. You know, the problem, of course, is it's most difficult to be putting money into the markets when they're down substantially. One of the reasons, of course, is that investors who give us money to invest tend to hold back, and therefore we don't have the cash to put money into those markets. But people are learning. There are a lot of investors who are willing to come in and go into these bombed-out markets.
Mark, because of what's happening right now between China and the U.S., are there any sort of long-term assumptions that we need to rethink on sort of the path of development on the Chinese mainland and also equally of the U.S.?
Many, many changes. I think one of the things that the Chinese realize is they cannot depend on the U.S. to be a buyer of all their products. So they are expanding globally. And, of course, the One Belt, One Road project is part of that program to expand the Chinese footprint globally so they can be exporting not only to the U.S. but to all other parts of the world, particularly emerging markets. So that's going to be a big change. The other change, of course, is that it's no longer cheap consumer goods. It's going to be technology. It's going to be high-grade technological products. For example, in the telecoms area, China is a big exporter of telecoms equipment around the world now. And I think that's going to continue and be a big, big factor going forward.
Mark, absolutely. So the thing is, do you look at these countries as they go up the value chain and you see what they're doing, as you mentioned, but who's going to be making the low-grade stuff? Is that who's going to be those players?
Well, that's the reason why I say there are going to be opportunities in some of these markets. For example, I was in Turkey a few weeks ago. Turkey is a big, big producer of low-cost garments. So they could become a replacement to some extent for Chinese exports of garments. Another good example would be Vietnam. Vietnam is now a big, big producer of low-cost footwear. So there are a number of these countries. Bangladesh, another big textile exporter. So these countries could become winners as a result of this so-called trade war.
And how do you invest around that thesis? I remember, Mark, the last time you were here as well, you talked about Vietnam, but the opportunities in Vietnam were still only in the private markets. Is there a public marketplace to some of these areas that you just mentioned?
It's now changing, and Vietnam is a good example where more and more of the big state-owned companies are going to be listed or are in the process of being listed. Many of these private equity investments are now going into the market. So the Vietnam market is going to be expanding pretty rapidly going forward. And you're seeing that in other parts of the world. You know, the private equity provides the feed for the larger listed companies. So this is going to be a very exciting area, not only in Vietnam, but in other parts of the world.
Mark, tell me, where would you not invest?
That's a good question. I can't think of any particular place where we would not invest. Of course, Venezuela comes to mind immediately. We would not invest in any country that doesn't want us. Vietnam is an example of a country that wants us and wants investors. Venezuela would be an example where they don't want us. So I think the two things we look at, of course, is the welcome we get from the governments involved. In other words, will they allow us to come in and, more importantly, get out? And, of course, foreign exchange controls. That's very important because we're running open-ended funds, and we've got to be able to go in and get out as well.
Mark, some of these, and to Rich's question, some of these countries that you mentioned, Brazil, Argentina, Turkey, you would be taking on substantial currency risk and exposure by investing in these markets. What sort of time horizon would one need for you to be able to look past that, that part of the exposure in your portfolio?
Well, yeah. Well, as you know, we look at a 5-year time frame. Usually we go in with the expectation that the company we're buying we will hold for decades, but at least for 5 years. So we look at the currency in the same way. And what we do is we evaluate the currency in terms of the price parity. In other words, is it undervalued relative to the U.S. dollar, or is it overvalued? If it's substantially undervalued, the risk becomes less, because that means we are going to be buying assets at a much, much lower U.S. dollar cost. So this is the way we look at it. And of course, foreign exchange, in the short term, there's no way you can predict what's going to happen to any particular currency. But in the long run, you can see these trends. And that's what we look at.
But Mark, you can't, these long-term investment plans and, going to what David was talking about there with currency risk being actually very much there. I mean, look at the Turkish lira. I mean, in 2000, it's, the dollar's appreciated 607% against the Turkish lira since 2000.
Yes, exactly. It's a good example. But you must remember that there's the other side of the coin. Many of these Turkish stocks have appreciated in terms of private equity investments we've made there, have appreciated as much as that, so that you've been balanced by the appreciation of the price of a particular stock versus the depreciation of the currency in U.S. dollar terms. So, yes, you lose to some extent, but very often you can make it up because of the appreciation of the stock price of the particular investment you're making.
Mark, just back to the trade issue. I mean, the core of it is really access to technology, and perhaps the Americans looking to stifle the growth of China in that space. Who's the biggest loser here? Does China lose the biggest because they lose access to U.S. technology, or does the U.S. lose more because they lose access to Chinese financing for their technology sector?
I think in balance, probably China will be the loser if this continues, because if the U.S. restricts the imports of technical products from China, this will be a big hit for China. If you just take, for example, the Apple Watch or the iPhone, a lot of this comes from China. If the U.S. puts a restriction on that, then, of course, that production will have to move to the U.S. So this could be a big problem for China.
Mark, very quickly, 10 seconds. Give me one trade that you are really convinced about. Very quickly.
I can't give you the name of a company, but I would say the one trade would be companies, consumer-oriented companies in India.